Hi, I'm Carson Cook. We're here at Token2049. I'm here with Toby Norfolk Thompson, the Chief Commercial Officer at Trident Digital. Toby, thanks for sitting down.
Thank you. Thank you for having me.
Absolutely. So Toby, to start, maybe tell us a little bit about Trident Digital and what you're focusing on as a firm.
Sure. So we set Trident Digital up 18 months ago. We're a digital assets advisory firm, also operating a lending conduit based in the British Virgin Islands. And we're really focused on providing lending liquidity both to users on centralized exchanges and within DeFi.
Great. So it sounds like given your product and your sort of conduit for lending and your probably global reach, you probably have a lot of thoughts on how the crypto regulatory environment is evolving. Would love to hear anything that you see developing across either the UK, the EU, or globally for the crypto regulatory landscape.
Yeah, no, certainly. And it's a very fast-moving landscape, and it's an area that we've had to look at a lot across the US and Europe and in other markets. I would say that there's been a lot more regulatory clarity, particularly in Europe and the UAE, which has been very helpful. There's still a high degree of regulatory uncertainty in the US, and certainly our choice of the British Virgin Islands was based upon both the Cayman and British Virgin Islands have well-established virtual asset service provider regimes, which have been very attractive. I think that also the nature of the digital asset market is that it involves highly dynamic organizations and individuals who are able and willing to move as is required. So that's definitely a feature of this market.
And are you seeing that clients are willing to move with their feet and change jurisdictions based on their operations?
Absolutely, yes. I think organizations, both existing organizations that are moving into digital assets and the many new digital asset organizations, are looking very carefully at where they want to be based. And I think people are increasingly able to move globally and work from anywhere. So they're more able maybe than other industries to respond more dynamically to a different environment, I think.
Sure. With a very mobile market like crypto is crypto lending in particular across the globe, is regulation adapting to that quickly? In other words, is regulation generally responding to market forces, or are market forces responding to crypto regulation?
I think inevitably the markets are responding to regulations more quickly. And I think a good example of that is in the UAE and particularly in Abu Dhabi, where there's been a high degree of regulatory clarity that's attracted some of the largest and most well-funded players. I think that there is a lot of global regulatory progress being made. The European MiCA rules have clarified a lot of aspects of both, say, trading, DeFi, and stablecoins. I think it's good to see that the new administration in the UK has passed the stablecoin legislation a fortnight ago and appears to be continuing on the path that had been set by the previous government. There's clearly less certainty in the US.
Yes, I would agree with that. So as you look across your lending conduit, I'm sure you're seeing demand to borrow and as well as lending supply. On the kind of lending demand, so on the borrow side for a minute, what's driving that? Is it largely market makers looking for market neutral supply? Is it people trying to lever up right now? What is driving the borrow demand at the moment?
That's a great question. And I would say that there's less unsecured financing available since the collapse of the major digital asset lenders in 2022. And as a result of that, all but the largest market making firms are having to be more creative with how they fund their activities. That's something we've tried to address directly at Trident with our lending conduit, where we provide funding to traders to operate on exchange. So thus providing flexible funding, but it's still being secured from the standpoint of the lenders. I think on the lender side, there's a wide range of organizations within the digital asset area, whether that's from miners to protocol treasurers to venture capital firms and to other early stage investors who are sitting on large positions. And they have a wide range of both risk appetites and governance and regulatory constraints. And I think that the opportunity there has been to really just listen very carefully to what people can and can't do and help marry those two sides up. I think the other thing that we see is there's a wide range of, I would say, private funds and family offices that are very prepared to lend against digital assets. And they often are looking for longer term commitment, really just from a sort of absolute return and fee perspective. And I think that's another interesting addition to the market.
So you mentioned sort of the 2022 wipeout of many of the lending organizations. Are you seeing more crypto native lenders pop up or more traditional finance players step into crypto lending, or kind of where are you seeing the market come back from an institutional perspective?
I think you're seeing both. I think a hallmark of the market as it rebuilds is that things are there's a much greater focus on credit risk and also on building regulation governance into the core from day one. And that's certainly a thing that we've adopted at Trident. So I think there are a number of new interesting crypto native lenders that have emerged, and there are undoubtedly more sources of private capital lending into digital asset markets, but looking much more carefully at the credit risk and the degree of security and or collateralization that's available.
Something that we've been very focused on at Membrane is providing sort of the tools necessary. As I know, working together with you at Trident, we have looked at providing the tools necessary to be able to manage that risk in a way that I think wasn't very commercially available in the last cycle. Something that is near and dear to my heart is DeFi. And I know before we were recording, we were talking a little bit about the DeFi market. How is DeFi affecting the lending market overall? And how is crypto lending absorbing or incorporating, adopting DeFi?
That's a very good question. DeFi is an area that we're very active in. And I would say that the emergence of a number of new stable coins, DeFi yields, both AMM and lending pool opportunities, is creating essentially a hurdle rate yield for dollars for lenders that are comfortable with working within DeFi and deploying in DeFi. And therefore, the opportunity cost of $1 to be lent to either a market maker or to another market participant is what that could in an AMM yield belt. And I think that one of the differences between now and maybe the 2021 cycle is that there's probably a higher degree of confidence around many of the yield venues that are available.
Makes a lot of sense. So how does the crypto lending market get back to the place that it was before 2022? How do we get back to that size and beyond? I know right now we're trying to rebuild to get up to that level, but what's the catalyst to actually take it there?
I think that's something that we're obviously very focused on. I think it's really a combination of clarity around credit risk, security, collateralization, and organizations which have got regulatory compliance and governance at their core and which are able to access the large pools of digital assets that are available, but are not currently able to access the markets because there's either a risk mismatch or some other kind of mismatch. So I think all those factors will drive the market.
And if we do get back to that same size or beyond that we were a couple of years ago, how do we make sure we don't repeat the same mistakes that many lenders made several years ago?
I've spent 25 years in banking, in credit trading and structuring, portfolio management, and really the old-fashioned, boring credit risk management, understanding your counterparty, understanding the risks that you're taking, and all the governance that goes with that, I think.
Boring is actually quite important in the lending space.
Absolutely.
We've seen what happens when it's not boring in 2022. So we're obviously here at Token2049. Have you been seeing a large sort of emergence of new lenders, trading desks, et cetera in here? Or does it seem like a lot of the same people that were here a year ago? And I'm happy to give my take as well.
I would say I've definitely met a lot of new people this week. Predominantly, I think the organizations which have existed in digital asset markets for some time now and are developing and building. And one of the things I love about this industry is deepening relationships with people. And I think, yes, I would say more than ever.
So what I've seen this week at Token2049 is it seems like there's a lot of capital that's interested in being lent out there and a lot of people that are trying to find the right ways to enter the market. So I think what you're doing at Trident Digital has a lot of legs to run here as people try to figure out they want to make sure they get in a much more safe and risk managed approach. And I think what you guys are doing is very innovative to get this going.
Cool. Thanks very much.
Absolutely. So Toby, have you seen any themes emerge this week in Singapore?
I think one thing that's been at the front of a lot of people's minds are exchange traded products and particularly development of some of the new ETP providers in Europe. And I think as they move from Bitcoin to other assets, Ethereum, Solana and stakeable assets, then considerations around managing liquidity for them is something that is at the front of a lot of people's minds and something that we're thinking about a lot.
It certainly seems like the future is hybrid in crypto in terms of you're going to have institutional OTC lending, you're going to have on-exchange, you said exchange-traded products, various on-exchange lending, as well as DeFi, and figuring out how to manage all those things is the holy grail.
Absolutely, yes. And as in conventional fixed income markets, understanding the interface between the different segments is the key to it.
Yep. I think given that, we probably should wrap up here so we can run to the race. So it was great, Toby. Thank you so much for taking the time to talk with us. And
thank you very much.
Thank you for joining.